In this week's episode of the Stockscores Market Minutes, I'm going to talk about the stock market crash and when it might end. I will then do my regular weekly market analysis. We'll discuss opportunities in the market and look at the day trade of the week on Apple. So when will the stock market crash end? Crashes tend to bottom far before the news gets better. And that's because investors anticipate what will happen in the future rather than react to what has already happened. The market is a discounting mechanism for future events. And so with regard to this virus as it spreads globally, it's really about expectations being worse than reality. And when that starts to show itself, the market will start to bottom. The market is trading on a lot of fear and uncertainty, and the market keeps going down because we just don't know how bad this pandemic is going to be. So markets, as I said, move in anticipation of future events, and investors will speculate on what will happen more than they react to what has happened. Now, stocks have been down sharply in price because of that fear about what will happen in the future. If expectations start to get positive, the market will stabilize and move up, even if the spread of the SARS-CoV-2 virus continues. And what we really want to watch is the curve of cases. And I'm going to show this in a moment. There's a very good website where you can watch this daily and in real time. And combined with that, we want to watch the market chart. So let's first look at this graphic. This is put out by Johns Hopkins University. If you do a Google search for Johns Hopkins University COVID-19 map, you will be able to find this very handy tool. And it's updated in real time. And the thing that I want everyone to focus in on is this little graph down in the bottom right, because it shows how cases in China have been growing, which is the orange line, and it shows how cases globally have been growing, which is the yellow line. The green line is deaths, recovered. Those are the number of people recovered. So what you can see is that the yellow line, which is the global spread of COVID-19, is a parabolic trend, and that's because it is growing exponentially. China made some measures late in January where they really locked down those regions of China where there was infections, and that stopped the curve from growing exponentially. And instead, it has more or less gone flat. They have contained it. And I think that is what the market is looking for to happen globally. There's all of these self-isolation and all the different things that we are doing in the rest of the world now, which China started doing some time ago to stop the spread of the virus. And if that can start to work and the parabolic curve starts to flatten out, that will exceed people's expectations, because right now the market doesn't know how bad it's going to be, and it thinks, well, maybe we're going to get 100 million people infected globally. Who knows? I mean, it could be even greater than that, of course. So that's the key thing to watch for. Now, the other thing that I watch very simply is the market chart, because I want to see how money is flowing. Now, I talked about this in last week's market minutes, but I will revisit that topic again. We need to see this downward trend line get broken. Now, this is a 30-minute chart, and I think that's a good thing to look at. You can go to stockscores.com, punch in the symbol SPY, and set it to a 30-minute chart. It's free. You can look at it as often as you like. And what I'm looking for there is a break of that downward trend line from a rising bottom. And that's what I discussed last week. So rising bottoms look like this. We've got a bottom here, and then we've got another rising bottom there. If the market had broken out midday Friday, we would have broken the downward trend line from a rising bottom. But instead, the market hit the downward trend line, got stuck, and rolled over and continued lower. And so we still don't have that market opinion saying that the buyers are finally willing to snap up bargains. And that's really what we need. So watch the curve for the parabolic curve, the exponential growth of the virus globally, to stop being parabolic, to stop being exponential and start to flatten out. And then also watch this chart. And I think you'll see those two kind of move together. All right, so on to our analysis of the U.S. markets, and starting off with the chart we were just looking at, which is the S&P 500 on this is actually a 60-minute chart, but same trend line. We want to see that trend line get broken from a rising bottom. If you want to see what that looks like, it happened here. There was a downward trend line. We had some rising bottoms build. We broke it, and that started the first attempt at a bounce. It failed. You'll know it fails because it moves down back below the previous support zone, and we had that happen there, and then of course the market continued lower. So what we're looking for though is that break of the downward trend line from a rising bottom. That'll be our clue that the market is going to try to bounce back. Certainly no sign of that yet going into the end of this week. Now this is that long-term monthly chart that I showed last week, and it is a big concern right now because that long-term monthly upward trend has been broken so far this month. Now, the month is not over. We are mid-month, well, third week of the month anyway. So it is possible that this could still make a comeback and close above that upward trend line, but certainly it is in the danger zone right now. So we'll have to see if we end up closing the month, but right now that's a pretty bearish signal. Looking at the Russell 2000, which is the small cap stocks in the US, they were trying to bottom the last few days. We had a few days of sideways trading, but it's really failed. And so it's that first attempt at a bottom, but I don't think it's there yet. So still want to remain bearish on US small caps. Looking at the Canadian markets, we have the downward trend still intact for the TSX, and therefore no need to get too optimistic on TSX stocks just yet. Looking at that longer term, or probably that TSX venture market, which is the microcap stocks in Canada. And you can see that we did what's called a dead cat bounce, where we have a sharp sell-off, hit a new low, and closed above the open. That was on Thursday. That is often an early sign of a bounce back. I think there's still work to be done. You want to watch that intraday chart to see if there is a break from a rising bottom, but there is some early indication that there are investors starting to snap up some of those microcap stocks in Canada. On to currencies, and huge amount of volatility in the US dollar. We can see it's really made some big moves as it becomes a flight to safety in some ways. People moving into the US bond market as a safety mechanism. And so, I mean, this is bullish, but it's so volatile that it's hard to really trade off of it long term. You really have to only trade it very short term. Looking at the Canadian market, or the Canadian dollar market, we've gone parabolic to the downside, probably trying to make a little bounce there, and we'll see if that holds. But really you want to avoid the Canadian dollar until it can start to stabilize and break a downward trend line from a rising bottom on the intraday time frame. On to interest rates, lots of volatility in the bond market. We went parabolic to the upside, we corrected back, and now we're starting to move up again. That means interest rates going all over the place. And right now, interest rates still very low relative to historical standards, or at least recent historical standards, but we've had lots of volatility in that. So if you're a bond trader, there's lots going on. And I think if you need to lock in a mortgage, great time to do it because rates are low. Looking at the commodities market, we have gold, which has sold off fairly significantly 2 weeks ago. It has managed to find support right here. It should hold that support. I think we bounce back short-term in gold, but I don't like the fact that that long-term upward trend line has been broken. And so I am not too optimistic about the future of gold. I do think there will be lots of volatility, and short-term traders can take advantage of that opportunity. But I would not think of it as a long-term trading vehicle right now, simply because there is too much uncertainty there. Looking at oil, of course, we've had that parabolic move to the downside. I think oil's down about 55% so far this year. Huge drop, and really it looks like a lot more when you look at this actual US oil fund. It's gone from 13 to 5. That's an amazing drop. Oversold, due for a bounce, but still no sign of a bounce. I saw a little bit of sign late this past week that it was trying to, but I don't think it's there yet. I do think that there will be an opportunity soon to buy oil stocks because they are just so oversold on fear. But we need to see that pattern I talk about, which is the downward trend, broken, rising bottom, break from a rising bottom. That hasn't happened yet on most oil names, although they are trying to build that rising bottom. And finally, the fear chart really gone parabolic to the upside. I'm not comfortable holding this beyond a day or two, and I think really you want to be a very short-term trader on the VXX. There's lots of action there, lots of opportunity to make money, but you got to be nimble, got to watch the chart very closely. It's really a day trading vehicle right now, and that's how I would treat it. So my ratings then, long term, I'm still neutral on US stocks just because they are so oversold. I do think that they are nearing the point where they have to make a little bit of a bounce back, but the trend is still down, so we'll call it short-term bearish. Same thing for Canadian stocks, same thing for gold, and oil bearish on both time frames. It just shows no sign of wanting to bounce back yet, but it is certainly overdue. So global stock markets will continue to suffer until there is something to give them hope that the spread of COVID-19 is getting better. When that happens, I expect tremendous opportunity to buy the bounce and profit. There are so many beat up stocks that are really undervalued as long as this doesn't stretch out too long. And I think that there will be a bounce back, but you gotta be willing to be patient and wait for the signs. Again, I talked about those in last week's Market Minutes video, and I encourage you to go back to the Stockscores YouTube channel to do that. Good time to remind you, of course, that if you subscribe to the channel, click on notifications, you'll get instant updates on all the new videos that I upload, and I'm trying to keep everyone informed on market action, at least on a weekly basis and perhaps more often. So until we get that little bounce back, I think it's really a short-term trader's market, and it really is a great market for short-term trading because there's lots of volatility. But as a longer-term investor, I think you got to be patient and wait for the signs from the market that there is, in fact, a bounce back coming. Fear is high still, so be cautious. All right, so on to the Stockscores market scan. And normally I would run a market scan on Stockscores where I'm looking at daily data to look for those longer-term buying opportunities. It's really not a great time to do that because we have so much volatility in the market. This is really a short-term trader's market. So what I suggested last week is you build a list of your favorite stocks, and I would really focus on the stocks that make up the major indexes. We're talking the big, well-managed companies, hopefully those that have good balance sheets. Be a little bit wary of many of the oil and gas names because they have, in some cases, a lot of leverage, and if they can't raise money and if the market continues lower, they might have a hard time surviving. So really pick the best companies in the sector, pick a few from a few different sectors, and then watch the charts for what I talked about last week, which I want to show you again just to drive it home. What you want to do is switch to a, let's say a 15-day, 30-minute chart. That's a 60-day, or 60-minute. Let's make that a 30-minute. And we're looking for that pattern I talked about, which is a break of the downward trend line from a rising bottom. So there we had a break of the downward trend line on Microsoft on Thursday, but there was no rising bottom. It was a double bottom. Double bottoms are okay, but not as good. What we want is a break from a rising bottom on this chart. So I think I have one to show you here. TVTY, I believe, is the symbol. And this did it. I actually bought this myself on Friday. And there you can see the downward trend line was broken, actually broken on Thursday, and then it made that rising bottom and then broke from the rising bottom late on Friday. And so that's the kind of signal I'm looking for. So pick your basket of favorite companies and just check them even a few times throughout the trading day on Stockscores or wherever you get your charts from, looking for that pattern. That is the way I would trade the market right now. All right, on to the day trade of the week, and this week's day trade is a short sell trade on Apple. We use the Stockscores action candle indicator, which triggered right there from what's called a descending triangle pattern. So any of you that have ever studied chart patterns will know that that's a pretty good, reliable indicator. When you get a breakdown from a descending triangle, it tends to go lower. We have an algorithm on Stockscores that looks for those. It's part of the active live service. You can go to the Stockscores website and learn more about that. Anyway, that was a short right there at just after 3 o'clock. It was, or just before 3 o'clock, I believe. For $100 of risk, you would short 70 shares. That's a nearly $17,000 position. But of course, when you're day trading, you can leverage that 3-to-1, which means you only put up 1/3 the capital. So for $5,640, you can short 70 shares of Apple. It ultimately closed the day at 9 times risk. That's what it means when we say RR, which means a $900 gain for a $5,640 position, which was a 16% return on a trade that lasted 16 minutes. Well, I hope that has been useful and helpful. And again, subscribe to the channel, click on those notifications with that little bell icon on your screen. Most importantly, trade well. It is a crazy market, but fun if you're a short-term trader, not so much fun if you're a long-term investor. It will get better. It always does. I've been through these many times, and trust in that. Just give it time. Things will get better. Have a great week in the market and trade well.